Hello, everyone. Thank you for joining us today. As you're coming in the webinar room, we want to welcome you. My name is Marcia Butler. I am the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation, and here are some housekeeping notes for you as attendees. You are muted, but we do encourage you to use questions and make comments using the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box, go ahead and leave your information to contact you as well. And if we can't get to your question during today's event, we'll make sure someone reaches out to you after the webinar. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. And I just turned that feature on, so you should be able to chat with us. I'd love to introduce you to our presenter today. Eric Lardner has over 30 years of experience working in the financial markets, providing market analysis and implementing financial strategies. His experience ranges from institutional clients to individuals, including many years of experience in New York City at what is now JP Morgan Chase, and in Texas with Eagle Strategies, the investment advisory at New York Life. In 2020, Eric founded Abundant Wealth Management and provides investment services, financial advice, and retirement strategies for clients nationally. He is the exclusive owner of the Retirement Income Source franchise in Dallas, Texas. Retirement Income Source is a national network of top fiduciary financial advisors with over $2 billion in assets under management. Eric focuses entirely on the pre-retiree market that's within 10 years of retirement and those already in retirement. As a retirement specialist, Eric has a high level of expertise and experience in the unique circumstances facing pre-retirees and retirees, including investments, Social Security benefits, 401k and IRA management, insurance, asset preservation, estate planning, and tax management consulting. Eric is a Series 65 licensed fiduciary and an investment advisory representative with Sound Income Strategies, LLC, an SEC registered investment advisory firm located in Fort Lauderdale, Florida. Well, Eric, I am so excited to have you back. We have a lot of attendees today, so hopefully we'll be doing some good education for these folks, and I'm going to turn the time over to you.
Very good. Thank you, Marcia. And first, I want to welcome everyone. Thank you for attending. So let's get started. 10 IRA and 401k mistakes. The first thing I want to talk about is a brief history of retirement plans in America, so everybody understands how these all came about. On August 14th of 1935, President Franklin Roosevelt signed the Social Security Act, and that created Social Security benefits for people. What evolved over the course of the intervening years was people started to think about ways that people could supplement their retirement savings, not replacing Social Security. So in 1974, Congress passed the Employee Retirement Income Security Act, or ERISA, which many of you may have heard that acronym before. That created IRAs and 401ks as we now know them. This gives Americans more incentives to plan for their retirement, whether it's coincidentally or not. This also began the reduction in corporate pensions. So we saw a dramatic decrease in corporate pensions being offered once 401k plans and IRAs became available to people. So the incentives include tax deductions on contributions. So these are automatic deductions that the funds go into your 401k plan automatically from your paycheck. So the taxes are deferred. There's automatic payroll deductions, and then what's also included that many people are not aware of are exemptions from creditors, and that varies depending on state, but for all intents and purposes, that's a broad exemption. Now, are there any catches? Some people call 401k plans a tax prison. Because you're contributing all this money pre-tax, when you pull the funds out, they're fully taxable. If you need any money before you turn 59 and a half, there is a 10% penalty. There are exceptions that exist. And once you get to the age of required minimum distributions, which is age 73, which we'll talk about more later, if you fail to make that RMD distribution, there is a 25% penalty. And again, I'll talk more about that later. So what this amounts to is you're contributing all these funds during your working life, and all these funds are growing tax deferred. They go in pre-tax, grow tax deferred, and then when you take them out, after accumulating all this wealth in your retirement savings, you have to pay tax on the crop. So you're putting in all these seeds, they grow and accumulate tax deferred, tax free. When you take them out, you're paying tax on the crop. So wanted everybody to have a clear understanding on that. So most people, statistically, it's about 80% of what we're going to cover today. People have issues with one or more of these issues. In my experience, that's closer to 100%. Not all of these are going to apply to everyone, but I think everyone watching today is going to have several of these that they're going to need to be on the lookout for. So let's get started with that. Mistake number one, not understanding how the Secure Act 2.0 impacts your retirement accounts. So it went into effect, it was signed in 2022. It went into effect on January 1st of 2023. There are new benefits for IRA owners, so I just want to cover that real quick. It eliminates the 70 and a half age limit for making traditional IRA contributions. So you're able to contribute longer, and they've increased the RMD age from 72 to 73, so you can wait longer to take your distributions. So that's an important fact right off the top to understand about RMDs. Now, if you turned 72 before this went into effect, you're still going to have to take your distributions. The new age 73 start date is not going to apply to you if you turn 72 before 2022. So the Secure Act does allow you to increase your contributions. That's another change in the law, and you may be able to neutralize the tax impact of RMDs if you have earned income. So let's just look at an example real quick. If you had, let's say, a $15,000 taxable IRA or 401k distribution or RMD, if you still have earned income, you can contribute, if you're married, up to $7,500 each into an IRA account, which would basically zero out the tax impact of having to take the RMD. So that's important. That's an important fact to keep in mind. Now, some of the rules that apply to that, for the increased contribution, you have to be age 50 or over. You must have earned income. You cannot contribute more than your earned income. So if you earn less than, say, $7,500, that you're going to be limited to contributing that amount. And Social Security benefits, pensions, interest income, dividends, and rental property income are not considered earned income. So you have to be employed to be able to contribute to your IRA. Now, the Secure Act also has rules for non-spousal beneficiaries. The old rules, you may have heard of the term stretch IRA. The old rules, it used to be if someone inherited an IRA, they could stretch out the withdrawals over the course of their lifetime. That changed with these new rules. What now happens is that anyone who inherits an IRA has to withdraw the funds within 10 years. So non-spousal beneficiaries have 10 years effectively to pay the tax because they have to make the withdrawals on inherited IRAs. So they have really three options on how they can take the withdrawals. They can take it out, they can take it all out in the first year. That's typically not advisable, particularly if they have earned income, want to be mindful of taxes. They can spread the distributions and taxes out over 10 years. That's typically what we see. Or you can wait until the 10th year and take a fully taxable distribution in the 10th year. So those are the kind of the three options that beneficiaries can use to withdraw from an inherited IRA under the new rules. Mistake number 2 that we find is missing a required minimum distribution. We talked about, the taxes, the tax prison at the top. So the first distribution, when you are first required to make your initial RMD, is due by April 1st of the year after you turn 73. Okay, and then all future distributions are due by December 31st of that year. So if you turned 73 last year, your RMD contribution was due by April 1st of 2023. If you turned 73 last year, now your RMDs are going to be due at the end of 2023. If you miss a distribution, there is a 25% excise tax that can go down to 10% if corrected in a timely manner. But again, you don't want to have to be dealing with that. So you have to be very mindful of your RMDs. And this is the #1 mistake that we see with IRA owners and people that have left their funds in a 401k, is they're just not aware of the rules insofar as RMDs are concerned. So let's look at a quick example. If you missed an RMD that was $10,000, the income tax, we're looking at a 30% tax on that. The excise tax of $2,500 is 25%. So that would be $5,500 out of the $10,000 distribution that would be paid to the government in taxes and penalties. So effectively, the IRS has now become your senior partner. So you want to avoid, again, missing any RMDs. Mistake number 3 that we see, and I'm going to spend a little bit of time on this, is not properly designating beneficiaries, which can leave a glaring hole in your estate plan. So let's talk about a specific example that will hopefully highlight what I mean by that. The U.S. Supreme Court had a ruling, Kennedy versus Plan Administrator for the DuPont Savings and Investment Plan. This was in January of 2009. What basically happened is the gentleman, William Kennedy, and his ex-spouse decided in their divorce decree that their daughter would get the proceeds from his retirement account, but they failed to change the beneficiary designation on the retirement account. So when Mr. Kennedy died in 2001, the beneficiary form governed, so the ex-spouse received the proceeds from the retirement account rather than the agreed upon settlement in the divorce decree where the daughter would get the proceeds. So it's very important to keep up with your beneficiary designations. I'm going to go through a couple of examples, additional examples real quickly here. So, and this also applies not just to your retirement accounts, but if you happen to have individual investment accounts where there isn't that 10-year window where people have to withdraw funds from. If someone's inheriting too much too fast, it's estimated that the average inheritance is spent between 90 days and 17 months of receiving that inheritance. You can see in the picture right here, this young lady looks awfully happy to be spending some money online using a credit card. So those who save money are better at handling money more so than those that inherit money. And this comes into play, again, when we're talking about setting up your beneficiary documents, helping to prevent losses. There can be spendthrift problems. There can be divorce issues, bankruptcies. You can accidentally disinherit heirs. This comes into play whether you're designating beneficiaries on a per stirpes or a per capita basis. That's probably a conversation for another day, but you have to be mindful of those different designations, the cost and time of probate, and then again, bad choices that inexperienced beneficiaries can make. And so getting a beneficiary checkup is extremely important. A lot of people have changes in the course of their lifetime. If they've been contributing to a retirement plan for a number of years, certainly they've had changes, whether through divorce or other circumstances where they need to have a beneficiary update. And considering a basic estate plan is very important. If I can back up for just a second to this previous slide. You know, if you have an heir that you may have concerns about spending issues, or may have bad choices and they're inexperienced with investments, having a properly set up trust can really be helpful in preventing a lot of these issues. And a trust is not meant only for people that have a tremendous amount of wealth. They're intended for people to really put some guardrails on their money so that they can govern more efficiently how their beneficiaries receive money and how they're able to manage it going forward. So it's very important to consider a basic estate plan in addition to the beneficiary designations. All right, so mistake number 4, not knowing the IRA or 401k rollover rules, which could cause immediate taxation. Spend a little time going through that. So why are the rollover rules so important? The reason is that there's 2 ways to do a rollover. The first is an indirect rollover. The second is a direct rollover, and I'm going to go through those details real quickly here. An indirect rollover is when you've got an entity, whatever Wall Street company you've got that's managing or that's the custodian for your assets, they issue a check directly to you, and then you have to then go deposit it into another institution where you've presumably opened another account. This is designated as an indirect rollover. You can only do an indirect rollover once every 365 days. If you do any additional indirect rollovers in the same 365-day period, those become 100% taxable. Then there's a mandatory 20% withholding. So we definitely want to be mindful of that. So let's go through an example real quick. John has 2 accounts. He's got one IRA account of $50,000 and another IRA of $250,000. He does an indirect rollover for the first one in January, and 3 months later does a second indirect rollover for the $250,000. So the second indirect rollover is no longer an IRA, which makes it fully taxable in the year that he rolled that over. So he's going to have to pay tax on the entire $250,000. So you want to try to avoid indirect rollovers and do a direct rollover. A direct rollover occurs when the custodian that's currently holding your assets is going to transfer the funds directly to another institution. So you're not acting as the middleman. All right, you're not receiving the check. The funds are directly transferred via wire transfer to another institution. And you can do this as often as you want without any tax consequences. And there's no 20% mandatory withholding. So it's important to understand the distinction between an indirect rollover and a direct rollover. And if anybody has any questions on that, we can talk about that at the end. Mistake number 5 is too many fees and loads on IRAs, 401ks, and other retirement accounts. Now, most people, the most common form of retirement account is a 401k, and oftentimes these have hidden fees, whether they're management fees, administration fees, or service fees. The average fee on a 401k is about 2.22%. And over the course of their working life, the average worker pays in excess of $138,000 in fees during their lifetime. So let's look at an example real quick, just to highlight how a reduction in fees might benefit you. Oop. Stay on the right page here. So let's say you've got a $200,000 account in a 401k. Over the course of 10 years, you're getting a 5% return on that. With a 2.22% annual fee, which is the average, the balance at the end of 10 years is going to be just over $263,000. On the other hand, if you were to roll it over, if you had your money professionally managed, a 1% annual fee is very reasonable. That would leave you with an account balance under the same circumstance of $296,000, which is a reduction in fees of almost $33,000, or 12.5% more with the lower fee. So it's real important to be mindful of the fees that you're paying in your 401k. I hear a lot of people say, oh, well, I'm not really paying any fees in my 401k. But when we get a copy of their statement and we take a look, we pull back the onion layers, it reveals the fees that people are actually paying. So be mindful of that. The number 6 mistake is not knowing how to properly convert your IRA to withdraw income tax-free. Okay, so there is a way to do that. Let's talk about that real quick. We've already talked about the taxes. From the day you first started contributing to your 401k retirement plan or traditional IRA, the IRS became your financial partner. So we've already talked about the IRS forcing you to take withdrawals when you turn 73 now for your RMDs. So these accounts are basically an IOU to the IRS when you have to start taking your RMDs. So how can we avoid that? A Roth IRA conversion could be a solution for that. Many people don't understand how Roth IRAs differ from regular IRAs. Your contributions go in after tax. So you've already paid tax on the funds that you're contributing to a Roth IRA. Whereas with a traditional IRA or 401k, all those funds go in before you paid tax, which is why you have to pay tax when you take the money out. So a Roth IRA, the contributions you've already paid tax on, so you're not forced to pay taxes on the distributions, and the gains are also tax-free as long as the funds remain in the Roth IRA. So you're paying a smaller tax bite today in order to save more on taxes tomorrow. And this may or may not be applicable to everyone. It depends on the individual situation. There are mistakes that can be made when you do this, but again, we advise talking to a professional before you think about doing this on your own. It can be very complicated. Mistake number 7 is ignoring the I. And what I mean by that is, how are you going to withdraw income from your retirement savings? I do a lot of educational workshops, and one of the questions I always ask is, do you know how much income your portfolio is generating? Most people do not know the answer to that question. They also don't know how much risk they're taking in their portfolio. So those are two things that you have to be mindful of, particularly as you're approaching retirement or in retirement. So if you have a pen and paper handy, I want you to write this formula down. This is a formula that we didn't invent. This is known throughout the financial services industry. It's TR equals I plus G. TR stands for total return. I stands for income, which comes from dividends and interest. And the G stands for growth. Now, anyone that's opened their financial statements or their 401k statements or IRA statements from last year knows that the market doesn't always go up. So the growth or capital gain can also be a loss. The total return on the market on the S&P 500 last year was negative 18%. So you may be familiar with the 4% cash flow rule, which said you can safely withdraw 4% from your retirement savings and not have to worry about the risk of outliving your retirement savings. So in this example, we're going to use $1 million. I know not everybody has $1 million in their 401k, but it keeps the math simple. Using the 4% rule, you should be able to withdraw $40,000 a year for life. But let's look at a situation where perhaps someone had retired in the year 2000 and they were relying on G or growth to supplement their income in retirement. Now, the average annualized return, total return on the S&P 500 from 2000 to 2019 was 6.05%. So if you're using the 4% rule, you'd be okay, right? Well, let's look at an example real quick. So what we're looking at here is, again, using the $1 million example. And again, I know not everybody has $1 million, but it keeps the math simple. Using the withdrawal method, what you're actually doing here is you're withdrawing 4% or $40,000 a year from the principal, which is creating a decline in your balance. You can see in this right-hand column the ending balance in the subsequent years. We had in 2000, if you recall, we had the dot-com crash. That was 3 consecutive years of a declining market. At the end of the third year, if you're withdrawing from your principal to supplement your retirement income, you're depleting your assets. You would have been left with just over half of your retirement savings at the end of the third year. By the time we got to 2008, we had the financial crisis. Now you're down to just over 40% of your original $1 million. Now this example shows, it demonstrates the danger of using growth to supplement your income in retirement, because the market does not always go up. This is the wrong way to supplement your income in retirement. What we like to show people is what's called the income method, which is withdrawing dividends and interest only to supplement your income. That is, you're not selling shares to generate income. You're only taking the dividends and interest. Now, the average dividend on the S&P 500 is historically about 1.5%. Again, we're using the same $1 million example, starting in 2000, the same returns historically, but we're only withdrawing the dividend. We're not selling shares. Now, I understand 15%, 1.5% or $15,000 isn't a lot to be excited about when you're talking about supplementing your income. It does, however, protect the principal, as you can see in this right-hand column. But by the end of the 13th year, you're just under the $1 million that you originally started with. So what if we had a portfolio that had a hypothetical dividend return of 4%? Again, we're using the same example of $1 million starting in 2000, withdrawing $40,000. Now, this is from the dividends, so we're not having to sell shares to generate the income. So what's that doing? If you look in this right-hand column, it's protecting your principal. So even though we've got a declining market during the dot-com crash during these years, and then the financial crisis in 2008, while the market is declining, you're not amplifying the declines in your retirement savings by then withdrawing an additional amount to supplement your income in retirement. So you wind up at the end of the day with almost the same $1 million that you started with, because you're doing it the right way. You're withdrawing the income rather than having to sell shares from your retirement savings. Now, if you don't need the income just yet, you haven't retired yet, this 40,000 in this example could be reinvested. So by way of example, if the growth in the market is 0, but you have a 4% dividend return, the total return would be 4%. So the dividends and interest amplify the total returns on your retirement savings, which is why we'd like to emphasize for people more of a focus on dividends and interest as they get closer to retirement. All right, we can talk about any questions about that at the end. Mistake number 8 is not moving 401k, 403b, and TSP plans to more flexible IRAs. So this begs the question, why are you participating in these plans in the first place, right? The number one reason is to get your employer matching funds, that's the free money. So you want to take the free money. We always advocate that. Now, when the contributions stop, the free money ends. You're not going to get any more employer matches. So that becomes time to get your money out of a 401k plan or other retirement plan. So what should you do with your 401k, 403b, or other retirement assets when you do retire? Should you leave the money in the plan, or should you roll it to an IRA? You should roll it to an IRA. Let's talk about what can happen if you leave the money in your retirement plan. Plan guidelines can restrict access to your money. That is, every 401k or retirement plan has different rules. They're not all the same. Some plans may have restrictive rules on when you can take money out, and you want to avoid those types of issues. Your investment options are typically very limited. 401k plans and other retirement plans have a mandatory 20% withholding. Most 401k, 403b plans do not offer a Roth conversion, which we talked about earlier. Most 401k plans only offer mutual funds, which creates an elevated level of risk because there is no direct ownership. Now, direct ownership is a concept that takes more time to explain, but utilizing only mutual funds in a retirement plan can increase your risk. And again, we talked about the fees and loads. Mutual funds are full of fees and different types of loads. So you want to be mindful of that. And again, the average fee for a retirement plan is about 2.22%. Now, rolling the plan into an IRA, a direct rollover, remember the difference between an indirect and a direct rollover. A direct rollover avoids the 20% mandatory withholding. So that's very important. Your money continues to grow tax deferred. You control where the money is invested. You've got much more control over the investment options. Now, IRAs also offer the option of converting to a Roth, which can save you taxes down the road. It can also reduce your market risk because you've got more investment choices, and you can reduce your fees and eliminate loads by getting away from mutual funds. So the 401k rollover opportunity, most people have to wait until they're at least 59 and a half before they think about rolling over, unless they've left that employer. In-service transfers to an IRA can help protect the principal from market downturns. And this last point right here is very important. I have a lot of people say, well, Eric, I'm still working. In fact, most of my clients still are working. They want to contribute to their plan and still get the matching free money, but they want to roll out of that plan to take advantage of the benefits of an IRA. 401k plan participants can continue to contribute after they've done an in-service rollover, as long as they're still employed by that employer, and they can still take advantage of the matching, but roll over the funds that are in the IRA, or excuse me, in the 401k to an IRA. it's important, if you want to do this, to talk to your plan administrator and ask them what your eligibility is for an in-service distribution. So if that's on your mind, you want to talk to your plan administrator and ask them that question. If you are laid off or change employment, you, as I mentioned earlier, you are able to move your 401k now. So if you have 401ks from a previous employer, you're no longer employed there, those are all eligible to be rolled over to a 401k, excuse me, to an IRA now. All right, mistake number 9, having too many retirement accounts. Now, you'd be surprised how often I see this. There are some people that have multiple employers over the course of their lifetime. They may have 3, 4, 5 or more 401k plans from previous employers. What we call those are orphaned 401k plans, okay? You do not want to have a bunch of old 401ks sitting around orphaned. You know, we call them orphaned or zombie plans, because who's managing those plans, right? You don't want to leave assets sitting around, particularly when it comes to RMDs. It can create a real problem when it comes to RMD time if you've got accounts all over the place at multiple custodians. So it really is a mistake that you can avoid by consolidating. So you want to avoid the retirement mess of having too many plans, and it's time to consolidate. All right. So mistake number 10, last but not least, is not exploring your options and possibilities. Let's use the example of health. Would you self-diagnose a medical condition, or would you see a specialist? Now, I'm not talking about a sunburn, okay? If you had something that you weren't sure what it was, you would want to talk to a doctor, and more than likely you would want to talk to a specialist, right? You're not going to go to a generalist if you need knee surgery. You're going to go talk to an orthopedic surgeon. So you want to talk to a specialist. The same thing applies to your wealth. You know, how important is your money? So we strongly advocate talking to a specialist, someone that deals consistently with IRAs and 401ks as an income specialist that can save a small fortune in either taxes, fees, loads. We talked about risk management. We talked about the problems that can occur with RMDs. And then we talked about how you can help manage your portfolio better, particularly when it comes to generating income from your portfolio if you've got more options. So you want to understand and talk to a specialist on how you can transition out of your employer-sponsored plans and into an IRA and or convert to a Roth once you've moved your funds over to a traditional IRA. All right. So with that, I'm going to conclude the presentation. I want to thank everybody for joining us, and I'm going to hand it over to Marche for any questions.
All right. And as I get into these questions here, I will tell our audience that you're welcome to put more questions in the chat, and we'll handle as many as we can. The question is, how do you report your RMD distribution? I know you have to do it by the end of the year, but how do you report that?
It just goes on your tax return.
Okay, so it's just a line item on the tax return.
And I'm not a CPA, so full disclosure, but it's just a line item on your tax return.
Okay, here's another question. Can I roll over my currently active 401k money to a Roth IRA without paying taxes? You talk about Roth conversions, it sounds like.
Right. So if you have a 401k, you can do a direct rollover, which I highly recommend. I don't recommend doing it yourself indirectly. You can roll that over to an IRA without any tax consequences. And then I would advise consulting a professional if you want to consider converting that to a Roth, because that process can be very complicated.
Yeah, so to clarify, you're talking about moving like a traditional 401k that is not Roth into a Roth, that's a conversion, and that would usually incur taxes, correct?
Some 401ks have Roth features to them.
Mm-hmm.
That is, some funds can be Roth IRA funds. Those can be rolled over into another Roth IRA. However, if you have 401k funds that are not Roth funds, those are taxable when you distribute the funds. So you want to roll them over first into a traditional IRA, and then you want to consider converting that to a Roth, so that if you've already got the Roth, you can roll those into the Roth. Typically, that's done over a 3, 4, 5-year period, because you want to spread out the tax liability over the course of a number of years. You don't want to pay that in one lump sum.
And I can see why it would require a professional clip, because that seems like a multi-step process that if you do it wrong,
multi-step process that you definitely do not want to do on your own.
and you don't want to incur a big tax bill accidentally.
Correct.
All right, here's another question. How many years before retirement should one start thinking about moving your 401k to a Roth IRA conversion?
Well, if you have any orphaned 401k accounts, I would recommend that you move those now, so that you can more efficiently manage those assets. If you're still working for an employer and you have an existing 401k account, ask your plan administrator if you're eligible for a in-service distribution. Typically, you're going to have to be at least 59.5 to qualify, and they'll tell you what percentage of your funds may be eligible to roll over to an IRA. So again, you can more effectively manage those assets, because you're going to have a lot more choices in an IRA as opposed to leaving those funds in a 401k. So I hope that answered your question.
So you talked about the average fee of being 2.22% in like an average 401k. Can you talk about what is average in an IRA that is managed by like an advisor or an outside party other than a 401k?
So, I use the 1% example because if you want your money managed professionally, that's a pretty reasonable fee. It's impossible, even if you're a do-it-yourselfer, it's impossible to get rid of fees altogether unless you just want to, be a stock trader. But then you're going to have, in most cases, some transaction fee of some kind. But if you're going to have a professional advisor, some advisors are charging a management fee, and they're using mutual funds. So you want to be mindful of that, because mutual funds are going to add another layer of fees on top of an advisory fee, which sometimes can double the amount of fees depending on what the mutual fund fees are and what the advisor is charging. And, I don't want to disparage any advisors out there, but handing off the responsibility of managing funds to a mutual fund manager is offloading the responsibility of actually managing the assets and double dipping on fees. So by way of example, you wouldn't take your car to a mechanic who then sent it to another mechanic, and when you came to pick it up, gave you 2 bills, right? So you want to avoid being double dipped on fees, but in general, a 1% fee is very reasonable to have your funds professionally managed.
All right, we're getting in a lot of questions. I want to thank you. We'll try to get as many of these done as possible. This is a quick one. What does RMD stand for?
RMD stands for Required Minimum Distribution, and that occurs now under the new Secure Act at age 73 with your retirement accounts, whether it's a 401k or an IRA. The government's going to force you to start taking money out. One exception, if you're still working and making contributions, even if you are 73 and have a 401k, they will allow you to delay your RMDs if you're still working for that company and contributing to a 401k.
Well, interesting. All right. Let's talk about strategy as far as working versus not working when you're doing a Roth conversion. So, when does it make sense to, if you've done a direct transfer, let's say from a traditional 401k to like a traditional IRA, and then you want to convert it and do that Roth conversion, what factors go into making that decision, and say you're working, and then maybe talk about when you're not working?
Okay, so the biggest issue when you're converting an IRA to a Roth IRA are the taxes, right? So you want to be mindful of all your sources of income while you're doing the conversion, whether it's Social Security benefits, if you have earned income, if you have perhaps an annuity that's paying you a lifetime income stream, maybe you have a pension. You have to look at your situation holistically, all right? You can't look at just one component of your income stream. You have to look at all your sources of income to see where you are from a tax perspective. And then try to, use the most efficient strategy. Again, I talked about doing it over the course of a number of years. It's typically the most efficient. You're going to want to most likely spread it out over a number of years. I wish I could give you one, patent answer that's going to apply to everyone, but everyone's circumstance is going to be different. So how you exactly do it is going to depend, which again is why I would recommend consulting a specialist.
Yeah, and I'm assuming that you're gaming it out. If we do it now, this is what your tax will be, and then
Right.
if it moves you up a tax bracket, that could be also a factor, correct?
Absolutely. Those are things we look at. So, we can only look at what the laws are at the time, right? If Congress wants to raise taxes, we can only look at what the tax rates are today, but we try to take everything into account so that you're minimizing your tax exposure and, maximizing the dollars that are actually getting transferred into the Roth.
All right. So we had a question about a couple questions about kind of that dividend investing, and I'll pop that slide back up again. But the question is, what kind of investments can garner a 4% or more dividend?
So there's lots of securities out there that can pay dividends and interest. We're not exclusively talking about dividend stocks. There are preferred assets. You can use BDCs, you can use REITs. There's all sorts of different types of investments out there that are market-based, where you can rely on consistent, steady, stable streams of income that either get reinvested if you don't need the income, or you can withdraw to supplement your income in retirement. So there's a whole spectrum of income generating securities out there, ranging from bonds to stocks and preferreds and everything in between. So, you want to be mindful, and again, we encourage using a specialist that knows how to invest in those things, and be mindful of what the markets are doing and how to invest best for your needs in that circumstance.
So here's another question kind of about that strategy. How do you know what you currently have in your investments? A lot of people just have their, have their 401k invest, and they don't really even look at it.
Yeah, so a lot of times, most frequently what we encounter, let me dismiss that real quick. You still with me? Okay.
Yep. Mm-hmm.
Sorry about that. So the question was,
like, how do you determine what's already in your investments?
okay,
And
so what we see most frequently when we're looking at people's retirement account statements is that they've got it in a target fund. So for example, you've got your assets invested in, the Fidelity 2025 fund or the Fidelity 2035 fund or some other mix of mutual funds, which is typically what 401k plans offer, is exclusively mutual funds. So you want to be able to look at the statement. That's, when we're doing this for clients, that's the first thing we ask them for is a copy of their statement so we can see what they're invested in. And then we can calculate how much risk they're taking, and we can calculate how much income they're actually generating from their portfolio, and we can calculate what the fees are. So we can identify all three of those items. Most people, when they look at a statement, after about a minute or two, they're ready to just put it down and go to bed. But we do that kind of thing all day long. So again, I would highly recommend talking to a specialist that does this type of thing on a daily basis, that can identify the fees, the risk, and actually how much income you're generating from your portfolio. It's not unusual to see zero income on a portfolio, and in some instances the fees are actually greater than the income that the portfolio is generating, which you definitely want to avoid.
Well, that's about all the time we have for questions today. I want to thank everyone for their questions. Again, if you didn't have a chance to get your question answered, go ahead and leave your contact information in the chat, and we'll be sure to reach out to you to make sure that that gets addressed. Well, on behalf of Advice Chaser, I want to thank Eric for being here and for being our presenter today. I want to thank the organizations that have made this webinar possible. To our attendees, look for an email soon with a link to the replay of this event, and you're welcome to share that replay with friends and family and anyone who might need this information. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, thank you again, everyone, for attending, and we will see you at another webinar soon. Oh, and thank you for the thank yous in the chat. We really appreciate that feedback. Goodbye, everyone.
Bye.